Two things came out of yesterday's FOMC meeting that you should pay attention to if you follow gold. What are they? Vince Lanci tells us next. Vince, thanks so much for joining me today.
Thank you for having me, Daniela.
So Vince, market's still digesting the FOMC meeting from yesterday, but no big surprises.
There were no big surprises, and I don't want to make more of it than what it is. But there were two things that I thought were important, not earth-shattering, but something you should pay attention to. Definitely one of them if you're a person who's invested in gold.
So what are they, Vince? Break it down for us.
The first, as it relates to gold, is simply the word count. If you want to look at the metadata, Bernanke said the word inflation more than he said the word jobs. And that hasn't happened in a while, which would lend itself towards inflation being on their radar, and that QE could be ending, or at least they're giving the impression that it could end, which is a bearish factor for gold. So basically, we're just counting words. And he said inflation more than he used to.
And the second point, Vince?
The second point is more a personal opinion that I distrust the information that comes out of the FOMC as well as governments in general. I don't ignore it. I have to pay attention to it because the markets do. But for example, January was cited as a month where weather had an effect on the economy. Maybe that's true. Maybe it's not. How could December, when Hurricane Sandy hit, not be cited as a reason for an economic slowdown or pickup? I'm just befuddled. So I think the weather was more important in December than January.
Vince, you mentioned inflation and how Bernanke used this word more than he used jobs. So a scenario of inflation does what to gold?
Well, I mean, there's two stages to it. The simple, obvious stage and the way the market will react is once the market sees, or once the Fed believes that inflation is an issue or jobs are no longer an issue, joblessness, I should say, it will pull back on QE. So an easing of QE, or I'm sorry, a removing of QE is the same concept as raising interest rates. Taking away the punch bowl is what they used to describe when talking about Alan Greenspan. That would be bearish for gold, and it would be bearish for bonds as well. Both those markets are, sticking with gold. The gold market would suffer because it's a non-interest bearing asset. If interest rates were to go up, which is what would happen if QE were reduced, then money would go into equities. It would go into assets that bear interest rates as well, and gold would suffer because of that mechanically. The reason is raising interest rates should keep a lid on inflation, so you don't need gold anymore.
Vince, let's look at some other key numbers that came out this week. Wednesday's surprisingly weak U.S. GDP figures coming out, indicating an economic contraction for the first time in 3 years. How concerned were you over these numbers? And also, are you going to be paying attention to those jobs figures coming out on Friday?
Well, the market pays attention to GDP. I don't pay attention to it as much as I used to. I feel like it's revised too often for me to take it seriously. But the jobs number is something I'm going to watch very closely. I think, again, when you look at the word cloud, if the jobs number is very weak, or what I should say is if unemployment is bigger than expected, then Bernanke may have to rethink his stance, assuming he is going to pull out of QE. So I think the jobs number means more to Bernanke than the GDP.
Okay, Vince, overall, where do you stand now with gold? What's your sentiment?
We're long gold and we're short bonds. That's our position right now. But my position on gold is as follows. If we have an inflationary scenario where the Fed recognizes that inflation is a problem, then gold will be sold. If we have a scenario where QE is not going to be withdrawn, then gold will not be sold. But if you look at how gold performs in a deflationary environment, or one where interest rates are rising, sure, it doesn't do well because it's a non-interest bearing asset. But we're long gold frankly, as a safe haven hedge against being short bonds. We think if inflation's coming, then bonds are a sale. And we'd rather be short bonds than short gold, if you look at it that way. But to give you some just focused numbers on gold, again, we like buying gold above 1,500. We like selling gold in the 1,800 area. We feel like we're in a big range. Our models tell us that the end is nigh for the bond bull market. There should not be a comeback here, and we are short. And it tells us that there's a high probability in gold that we're going to make new highs. So we have a trade on. It's a Texas hedge. We are bullish on gold, but we're not heavily invested right now.
Vince, when you mentioned those numbers you're looking at for gold, is that a shorter term outlook or long term?
Oh, no, that's longer. That's over the next 6 months to 2 years. So I still think, look, I just don't think the gold market ends with a whimper. And a bull market does not end with a whimper. It ends with a major top, a bang, a blow-off rally. We haven't had that yet. So I just don't think that's going to happen. And if I'm wrong, I can live with that, because I believe if there is an economic deflationary crisis starting from Asia or wherever, gold will be the tallest pygmy. It will be, everything will get sold and gold will survive.
Vince, let me ask you this, though. A recent GFMS report showed that in the first quarter of 2013, central bank buying is supposedly close to 300 tons of gold. And if we compare this to last year, where we were a little over 500 tons, can we say we're off to a good start?
We are. You have to take the other side of the trade, though, for a second and look at it before you get totally excited about it. They bought 300 tons of gold this year so far. That's great. Look at where the price of gold is. Well, gold market hasn't really rallied. Imagine if they weren't buying. That's scary. The second thing is, and this is the bullish statement, I do believe they're buying gold because gold will be a much, much bigger factor in FX balance sheet hedging for countries. The buying of gold will not stop for a long time, especially by China. The third thing is, and this is the other bearish thing, central banks were sellers of gold at the lows. So you have to ask yourself, are central banks smarter now than they used to be? I think the answer is yes. Do they just blindly go into the market and just do stuff now? No.
Right. I guess the point I'm trying to make, Vince, is even though central bank buying is present, it's not enough to help propel gold prices to $1,850, $1,900. So what's stopping gold?
That's a tough question. I don't think, jewelry demand should be down in the current economic environment, especially with the excise tax in India and what have you. We talked about that before. But I think if you want to look at it in what we call strong hands, weak hands, I think you can make this case very easily. The weak hands are the hedge funds and the individuals and the firms that were long gold as a safe haven asset along with bonds, and they're selling into the economic recovery. And the strong hands, in this case, I think the central banks are not the dummies. The strong hands are the central banks buying because of the growing need for gold as a monetary hedge for FX currency issues. So I think there's a base for gold.
Vince, what would make someone strong and someone weak?
Well, in this example, the weak hand is the hand that buys on strength. They buy because they think what is happening will continue to happen, and they chase the market. And hedge funds do that a lot, momentum funds. The investor, not the trader, is the strong hand, the deeper pocket. And when the central bank buys, they're not chasing the market, they're letting it come to them. So you could easily make the case that although the market hasn't rallied and there's been a ton of central bank buying, that's because the central banks are just being patient. Their monetary policies are making gold come to them. And I think in the end, gold will be in the strongest hands on earth.
Vince, that's just a beautiful statement, that gold will be with the strongest hands on earth.
I didn't say the smartest, but they will be in the strongest hands on earth. You can't fight the Fed, or any Fed for that matter.
Vince, thanks for your thoughts today.
Well, thanks for having me.
And thanks for watching this edition of Reset with Vince Lanci. You can email me any comments or questions at newsfeedback@kitco.com or tweet me, join this conversation at Daniela Cambone. Thanks for watching.